Hey everyone, welcome to COMM 217 final mock exam number 3. Before I begin, I just want to make sure everything's intact. Can you guys just give me a hands up if you guys can hear me, you can see me, and you can see our screen? Okay, cool. I'm going to lower the hands and let's begin. So on September 1st, 2021, Patel Tool and Die Ptd incurred the following costs in acquiring equipment, land, and building. So the purchase price of the equipment was 105. That, of course, we're going to consider. Purchase price of land and building was 840. Delinquent real estate taxes on the land is 4,000. Delinquent real estate taxes on the land. This, by the way, we're going to put it to land. Right. This, of course, goes to equipment. This is for both land and building. Renovation cost of the building prior to use. This is only for the building. And costs incurred for the building dedication ceremony. This we would expense. On September 1st, 2021, the market values of land and building was 600,000 and 300,000 respectively. A. Calculate the acquisition cost of both land and building. Okay. Question here, Brandon.
Yeah, why do you expense the ceremony?
Because the ceremony doesn't enhance the value of the building. It doesn't, make it better. It's not a cost that should be added to the cost of the building.
Okay.
Okay. We have land is worth 600,000 and the building is worth 300,000. We look at fair market value. Take the percentage. This is 66.66%, 33.33%, and the price of both was 840. 840. So here we're gonna get 560. And here we're gonna get 280. So for land, we have 560,000. This is the allocated cost of land. Plus we had the delinquent taxes. So the cost of land is really 564. And same idea for the building. The allocated cost of both was 280,000. Plus the building had 20,000 of renovations. So plus 20,000 of rentals. 300,000 is going to be the cost of building. Any questions? Okay. Company depreciates the building over 30 years with a 30,000 residual value using the straight line method. Calculate depreciation expense for the building December 31st, 2021 and December 31st, 2022. So for part B, your depreciation cost minus residual value over useful life. Cost of the building is 300,000 minus a 30,000 residual value over 30 years. We get $9,000. This is your depreciation per year.
I have a question.
Yeah, what up?
Where did you get the 840,000 like for the land and oh never mind. I see.
Price of both. Okay. So for December 31st, 2021, how much depreciation are we going to record for the building? What do you guys think? Brandon?
Well, since right now it's September 1st, you
Mhm.
have to see the amount of months between September and December. So I think that's 4 out of 12 times the 9,000, which gives you 3,000, and that's the expense for that part. And then for the next year, it's just another $9,000 because it's one full year.
Exactly. This one's going to take it. Exactly, the full 9,000. You got it. All right, so because right now we're September 1st, you guys have to catch that. Since we're in September 1st, we're only depreciating from September to end, from September 1st to December 31st. So you're taking 4 out of those 12 months, but next year you take the full 9.
Could you go back to the question so I can just mark down all the values that are up there so I know where you're getting the numbers from? Okay, thank you. Just pause there for like a minute.
Any other questions?
Yeah, where'd you get the 9,000 from?
When I calculated the depreciation, we did 300,000, which was the cost of the building, minus 30,000 residual over 30 years, and that's how we got 9,000.
Okay, thank you.
And part C, prepare the non-current assets section. So what would be shown? We would have land at 564. We would have building at 300,000 less accumulated depreciation. What's the accumulated depreciation here? How much is in here? Rather.
Well, it says, I'm guessing that 2012 is supposed to be 2022.
Yeah.
So it has to be that 3,000 plus 9,000, so it's $12,000 in depreciation.
Minus the 12 will give you 288,000. And we would just have equipment. Leave this at 105. So my total non-current assets is 957. Fabrizio.
Yeah, it's just a basic question. I'm just confused. Why do we record the like depreciation for next year as well if it's just asking for 2021, like the non-currents? Or it says 2012. I'm guessing it's a typo.
Oh yeah, this is 2020. I meant 2022.
Oh, okay, perfect. Makes sense. Thank you.
All right, so that's that. Inventory. So Vines Inc. is a wine storage located in Montreal. During 2012, Vines Inc. had the following transactions related to a specific brand of French wine. So they give us all that. One sec. They give us all that. There were 60 bottles in the beginning inventory at a total cost of 1,005. Vines uses perpetual inventory system. Calculate the cost of ending inventory and the cost of goods sold on October 31st, 2012, using the weighted average costing method. Okay. So, part A, we have number of units, the cost per unit, and total cost. So your beginning inventory, you have 60 units at a total cost of 1,005. So we have our first purchase number one. We buy 120 at 26. We buy 120 at $26. That's 31.20. And now we have a sale. So it's time to make the total. At this point in time, we have 180 units for a total cost of 46.20. So what is the average cost per unit? $4,620 was spent on 180 units. So 25.67. 25.67. So now on October 11, we have a sale. We sold 100 units, so you're gonna minus 100. This number, you drag it down. That's gonna be 2566.67 as a negative. So we now have 80 units left at 2053.33. Are there any questions? Second purchase. We buy 70 at 27. 70 at 27. So that gives us 1890. So at this point, we have 150 units at 39.43.33. And now we have a sale. So since we have a sale, it's time to make a unit cost. This much money was spent on 150 units. $26.29. So our sale two. This time we sold 60 units. Drag that down. 26.29 gives us 1577.4. And the third purchase number three, we buy 80 units. So now we have 170. We bought these units at 28. So that's 2240. 4605 90. So now let's answer the question. What is the cost of goods sold? Who can tell us? What's the cost of goods sold? What and what? Brad.
The cost of goods sold is your sales, so that 2566.67 plus 1577.40.
Very good. 2566.67 plus 1577.40. Gives 4144.07. That's the COGS. And what's the ending inventory? Finish it off, Brandon.
4605.93.
4605. Questions on this? B. Identify the accounts as well as the amounts that are affected on October 11 and October 25th. Use the basic accounting equation, assets equals liabilities plus shareholders' equity. You're required to fill the column out with proper account names and amounts of the transactions. Okay, so October 11. Assets equals liabilities plus shareholders' equity. So on October 11, we're gonna have accounts receivable with sales revenue. We have how many, what time is what here, Braden?
I just want to say, how do you know that it's accounts receivable? Did it say?
Either accounts receivable or cash.
Yeah, because it didn't say that it was accounts. It was on accounts. That's why I thought it was cash.
Or cash, they would give it to you.
Okay.
So it'd be 100 at 36. So it'd be 100 units at 36. So I'll put here accounts receivable or cash plus 3,600 and sales rev increases shareholders equity 3,600. Also on October 11, we got to record an inventory going down by 2566.67. And our cost of goods sold goes up, which decreases shareholders equity 2566.67. And they also wanted for October 28th, this is a purchase. So inventory is up to 240. That's what we had over here. And either you say accounts payable goes up 2240, or inventory goes up 2240 and cash goes down 2240.
But for this particular question, because it didn't specify that the purchase was made on account, realistically, you would use cash, right? Unless it's,
Or
unless
account.
it says explicitly on account, you assume it's cash.
Yeah, sure, but on the exam, it's gonna be clear. It's gonna tell
Yeah.
you cash or account.
Okay.
Okay. And D, they wanted us to calculate the average day, I meant to sell inventory. Sell inventory and interpret the results. Oh, okay. So you have to use another one here. Well, if you try doing average days to sell, inventory, you get 365 over the inventory turnover ratio. So 365 over, now you gotta figure out inventory turnover ratio, which is your COGS over your average inventory, which your COGS, as we said, was 414407. Over the average inventory. So that's the ending. That's the beginning. Divide those two by two. $1.357 is what you get. And then you shove that there, 1.357. And you get 268.9.
I have a question.
What up?
Would you say that this is pretty much guaranteed to be on the exam, these two equations?
Nothing's ever guaranteed, unfortunately, on the exam. Like for sure, there's gonna be something on the inventory, that's for sure. Sometimes an answer, sometimes they put it in the multiple choice. It depends the semester.
Because on the first mock you gave it, the same exact, pretty much the exact same question was on that mock as well, so.
Yeah, so if it comes up long answer, then for sure they're asking you all this. But it could come up multiple choice and then they wouldn't ask you as much. You know what I mean?
Okay.
So it takes the company 269 days to sell inventory. This is not good for a wine business. Right? If these guys were Bombardier selling planes, fine. But for a wine business, no good. Rather.
I forgot, but what does the inventory turnover tell us?
Basically how many times you're selling stuff relative to inventory. So you're basically selling 1.35 times your inventory.
Okay.
Question 4. So I put a lot of stuff on taxes. Let me know how it comes up after the exam. Following information is regarding the preparation of 2023 income tax return for Andrew, who's a professional engineer, who's a Canadian citizen. Okay. So all this stuff. They want to know what's his total income, identify items that he's eligible to deduct from his total income, and what items have no implications. Okay. So total income, what could he deduct? What has no implications? So let's start with he has a gross salary. We're gonna shove that in part A. I'll do A here. He has a gross salary, 213,755. A is total income. B, interest earned on GICs with RBC of 3,600. Is he taxed on this? What do we do with this one here? What do you guys think? Braden?
I think he's taxed 50% because it's capital gains.
If it would have been capital gains, 50%, but this is interest, is different. Capital gain is when you buy something and sell it. Here, this is just interest, where you take money, you lock it in, and that's it. See the difference?
Yeah.
Cool. Like this would be capital gains over here.
Okay. I thought it was the same thing.
You know, these are different. So we have interest with interest of 3,600. Okay. We have interest earned on GICs. Inside is RSP. What are we gonna do with this? Is this the same treatment? The retail.
You don't tax until you take it out, so you don't touch it.
Exactly. You're not taxed until you pull it out, so this has no effect. So A is the total income. B is what we could deduct. So I'll put B, let's see on this page. B is deduct. And somewhere in the middle, we'll do no effect. So this would go in the no effect. Interest on RRSP wouldn't have any effect. In here, we sold 65 shares of ABC Inc. at $40 each. Andrew acquired all of the shares in 2008 for $700. Okay. So we're gonna have capital gains. Capital gains.
Question.
Yo.
Yeah, in the total interest, do you just put everything at face value and then like deal with the taxes like in the deductible?
I'm sorry, can you repeat your question?
Like why isn't the interest earned on the investment like taxable?
Because it's within his RRSP.
I'm talking about the one before that.
It is taxable.
It is okay, it is taxable.
Yeah.
Okay.
It
So
is.
how do we deal with that then?
Well, basically, we're saying everything he has to pay tax on, and then eventually we're gonna get his total income, which is everything he made.
Okay. Okay, okay.
Hashem.
Or the same question about the interest earned by the RBC. Isn't it deductible because it's interest on investment? So if it's for investment, you deduct it, or it's a non-taxable benefit.
If it's interest paid, so if I borrow money for investment, that would be interest paid, but this is interest earned that we receive.
So it's only paid. So here if it was paid, then we deduct it.
Yeah, exactly. Like if you earn interest, the government's gonna tax you. But if you pay interest, then you could deduct it, as long as it was for investment purposes. Make sense?
Yeah, perfect. Thank you.
No problem. So we sold 65 shares at $40 each. So 65 times 40, 2,600. And our cost was 700. So for capital gains, I could say 65 times 40 minus 700 is 1,900, and only half is what we pay tax on. So 950. Done. Andrew paid professional dues of 650 during 2023. What do we do with that? He paid professional dues.
Do we deduct it?
We deducted. Very good. Professional dues of 650. On January 1st, Andrew's given an option to acquire 450 shares he works for at a price of $35. Anytime before December 21st. The shares are trading at $32 on this date. Okay, that doesn't matter. On November 15th, he exercises option and acquires the shares. The shares are trading at $40 on this date. Okay. So basically, we're gonna have the stock options. And the stock options is essentially 40 minus 35 times 400, times 2,000 shares. And that gives us 10,000 as taxable. As part of Andrew's employment contract, Andrew's provided with medical insurance, value of 4,000. Life insurance, 2,500, and dental insurance, 3,000, all which the company paid for. So how does it work over here?
Is that no effect?
On which ones?
No.
Some of these have no effect, but some of these have effect. Dahlia.
I think it's only life insurance that is not covered or doesn't have any effect.
So life insurance is, you're saying what over here?
Well, the dental and the medical, we could deduct, but not the life insurance, I think.
You're very close. You're very close.
No effect for medical and dental, then we deduct life.
Okay, so no effect for medical and dental is good. This is no effect. So look at it this way. Before you could deduct something, you're only going to be able to deduct something if you paid for it. It's not going to be like someone else pays for it and you get to deduct it. You're not going to get a double benefit. You know what I mean? So since the boss paid for it, we're not going to deduct anything, that's for sure. It's just a matter of, is it taxable or not? So medical insurance and dental insurance both will have effect. But life insurance, we're going to be taxed on. Life insurance, here, we're going to be taxed on.
They add it to your salary, right?
That's exactly what it means to be taxed on something. Yes, they take the value and add it to your salary and all the other income you have, like interest, capital gains, stock options, whatever. You okay, Baron?
Yeah, I was just gonna confirm. So to like under deductions, you can only deduct something if you paid for it.
Yeah, of course.
Okay.
Anything you paid, well, something you paid might be deducted, might be deductible or zero. But it's not going to be that you paid for something and you're taxed on what you paid for. So similarly, it's not going to be that you received something and you get to deduct it. See what I'm saying?
Yeah, I just meant it as like if for some reason I get stuck and I don't know, it's like at least a reference, something I can maybe think about.
Well, you're only guessing between two, right? If you
Yeah,
receive
exactly.
either taxable or no effect. But if you paid for something, it's either deductible or no effect. So you can always eliminate one. You know what I'm
Yeah,
saying?
yeah.
Life insurance there. Bang, bang, bang. Andrew's part of the company's RPP plan, in which Andrew contributed 2,500 into his RPP. Andrew's employer contributed 80% of this amount to Andrew's RPP. So Andrew put 2,500 in his RPP. What do we do with that?
Is the employer's no effect, right?
Employer put money is not taxable, so no effect, correct? And what about when Andrew put money?
Is it also no effect?
No, so when Andrew put money, you could deduct it. That's why they encourage you to do these plans, because the money you put, the money you pay, you get a minus, and the money your boss pays is tax free, no effect.
This may be a dumb question, but could you like explain what deductible means, like in just this in like this context?
Yeah, deductible means gets subtracted from your income. So, like, let's say Andrew has professional dues. Well, on current, he's gonna have minus 650. You know what I'm saying?
So like so he gets taxed on less?
Yes, exactly. Yes, you got it. We're gonna minus it from his income, so the result of that means he's taxed on less. Yes.
Oh, yeah. Okay, that's how they say it. Okay.
So we said what he could deduct is the RPP, his contributions of 2,500, but the RPP from the boss, not taxable, not deductible. This has no effect. Andrew's employer provided him with a brand new computer, which uses 70% of the time for work and 30% for personal. Cost of the computer is 1,003.
Wait, before you move on, I don't, did you write the numbers like in the no effect?
No, because they have no effect.
Oh, okay. Makes sense.
Andrew's employer provided him with a brand new computer, which uses 70% of the time for work and 30% personal. The cost is 1,003. Brad,
I believe it is taxable. I'm not sure. I don't entirely remember if he's only taxed on the part he uses for personal use or if he's taxed on the whole thing.
Isn't it it is deductible because the time spent like on the like using it for work purposes exceeds the time like for personal use? Isn't it like it has to be over 50% for work use for it to be deductible?
okay, so you're very close. So you're definitely onto something. It has to be more than 50% used for work, not for it to be deductible though,
Taxable. Is it strictly non-taxable?
for it to be not taxable. Exactly. This can't be deductible. I'll tell you why. Because the boss paid him a computer. So it's not going to be that the boss buys something for you and you get to subtract it in the tax return. You're not going to get a double whammy. You know what I'm saying? But what you're thinking of is right. Since it's over 50% for work, we're just not going to be taxed. Make sense? Sam, you okay? I guess so. So no effect. Computer paid by boss because it's over 50%. And I'm happy to chat about it, Hashem.
So just to make sure the no effect, it's basically non-taxable, right? Like this is what's no effect.
Not deductible either.
So it's both.
Yeah, it's something that we're not going to pay tax on, but we don't get to deduct either.
Okay, so non-taxable and deductible are the same thing. The only thing that's different is when the employee pays or when the employer pays.
Repeat that, sorry.
So no effect for so non-taxable and deductible are the same thing.
No. Non-taxable means you receive the benefit, you're not taxed on. Deductible means you paid for something and you get to subtract it.
So they have the same effect on the gross income.
No. If something is not taxable, you do nothing with it. If something is deductible, you minus it.
Okay, thank you.
No
I,
problem.
I have a question.
Yeah.
If it was mostly used for personal use, would they add it to your like salary for you to pay taxes on it?
Yeah, but then you would consider it as a gift and you have the limit of 500.
Oh, this limit 500. So then what would happen?
If this is the only gift he got, 1,003 minus 5, 800 is what he's taxed on.
Okay. Okay.
Brevin.
So it's only no effect because like it's not deductible because the employer paid for it, and it's not deductible because most of it is being used for work.
And it's not taxable because most of it's used for work.
Okay, but if it was taxable, he'd only be taxed as if it's a gift and on the $800 difference.
Exactly.
Okay.
Wait, is everything in the gross salary taxable?
Is everything in the gross salary taxable? Yes.
Okay. That's why you were only at it for 800. Okay.
Is it always are you always subtracting 500 like when you're given like tools or whatever from the like your company and you're using it more for personal use? So like there was another mock exam that I attended, and so like for a company car, if you use it more for personal use, are you still subtracting the 500?
No, for a company car, it's different. If the company owns the car, that's something different. If you're using it more than personal, you don't have the second portion of the formulas for the standby charge and the OCB.
Okay.
Dahlia.
So is this considered a gift? Is there a difference between a gift and like work related items?
Well, like here, we're not gonna consider it a gift because he needs it for work. He's mainly using it for work. You get what I'm saying?
Okay, but is there a difference if it mentions it's a gift?
Well, if it's something personal, like if your boss gives you hockey tickets, then that's a gift, right? But if he gives you hockey tickets and tells you take this time off for dinner and try to make a sale, now it's for work. You get the difference?
I got it, thank you.
No problem. Andrew spent $800 on an office desk. So what? Can't do anything with this. So no effect. He can't deduct it, nothing. Brandon.
Why can't he deduct it if he paid for it?
Because he's an employee. If he was self-employed, he'd be able to subtract it. Same reason if you buy things, you have an office where you're living, probably have some sort of desk or whatever, that doesn't get deducted in your tax.
Okay.
Okay. Andrew's provided with a monthly allowance of $20 to assist with any expenses that he's required to pay relating to the computer. Andrew's employed from January to December. So all allowances are always taxable. So you got an allowance here. We're gonna say he got $20 a month times 12 months. He literally got an extra $240 in cash. So, okay. During 2023, Andrew received a $20 gift card to the spa as well as hockey tickets at $250. What's the move here? Braden.
Because it's under $500, it is a it's a gift. I think it's just not taxable.
So close. Like if it would have been a $200 laptop and $250 watch, then you'd be right. But
There's just no effect.
not that is no effect. Something here is taxable, even though it's less than 500.
The spa,
Yeah, why?
because it probably has nothing to do with work.
Not that it has nothing to do with work, is that it's cash or near cash, like we said in the notes. So gift cards is considered cash. Because if you get a gift card, well, what are you doing with it? You're spending it. So it's as if he has an extra $200 that year. So he's gonna be taxed on this. That was the trap over here. The trap was saying less than 500, nothing. But this 200 is actually taxed. But the hockey tickets, no, because that's less than 500. So spa gift card. We're gonna tax him on 200, but hockey tickets have no effect because it's less than $500. Any questions? There. Andrew is interested in learning mechanics, and due to his outstanding performance during the year, his employer paid $3,000 for him to attend this course. Well, what's the move here? He works as an engineer and he's learning mechanics.
No effect.
Not no effect, Fabrizio.
I mean, it was tricky, but I just said,
It was tricky.
oh wait, never mind. No, sorry, I messed up. My bad.
Good. Hashem.
It's taxable because it's on performance.
Yeah, so two reasons why it's taxable. Either one, because it's on performance, or two, why else is it taxable? Right.
Because I believe because it's not offered to everyone.
We can't conclude that, but yeah, that's the same thing as performance. Fabrizio?
Doesn't pertain to his job, like it doesn't help the employer make him better at what he does.
Exactly. He's working as an engineer, and his employer is paying for him to take a mechanics class. There's no relevance, right? Mechanics to fix cars and engineers. But if his employer were to pay him an engineering class, that would be tax free. Since it's mechanics, has nothing to do with his job, he's taxed. So mechanics class. Mechanics tuition. Not related to work.
Is there a certain amount that's valid for or isn't valid for?
For tuition, it really comes down to is your boss gonna benefit from it or not. Doesn't matter the amount. Andrew sold his home for 300,000. He purchased it 8 years ago for 60,000. What's the move here for retail?
Doesn't really say, but since he like lives in it, it's untaxable.
Exactly. It's his home. That's the home he lived in, not taxable. So no effect. Sold. Principal residence. In order to on April 1st, Andrew's employer lent him 100,000 at an annual rate of 2% in order to assist him with the purchase of a new home. Assume the prescribed rate for all of 23 was 5%. So here we got a loan less than the market rate. So we're gonna have interest benefit. Basically on 500,000. How much we got loan? Sorry, on 100,000 times the difference between 5% and 2% times 9 out of 12 months is what we have. It is 22. And then you add this all up.
Sorry, why are you doing the difference between 5 and 2%?
Because you're taxed on the interest saved. So he did pay 2%. He saved the difference of 3.
Okay.
For retail.
And it's just 9 months because we just naturally assume like the fiscal year's December 31st, whatever.
Well, as individuals, our calendar year is always December, yes.
Okay, perfect.
That's why we're paying tax now in April. We're all filing our tax return for anything we made January to December 2023. Andrew paid a moving company to transport his furniture to his new house. What do we do with that?
Is that deductible?
What did you say? If that is?
Is it deductible?
Yes, for sure. Moving expenses, you're allowed to deduct. Andrew contributed 2,000 to his RSP and 1,500 to his TFSA. Oh, sorry, Brad, any question?
No, I was gonna say the 2,000, I think is deductible.
Correct.
The TFSA is nothing.
RSP of 2,000. And TFSA. Gotcha.
So if he was not like if he was getting money from the RRSP account, then we add it back to the income as it is.
When money goes in, you minus. When money comes out, you plus.
Okay, and for the TSFA, it's we don't do anything in both matters, both ways.
Exactly. The whole thing is tax free. Even the money you make in there is all tax free.
Thank you.
What does RRSP mean?
Registered Retirement Savings Plan.
Oh, okay.
It's basically the government wants you to make your own pension, like your own retirement fund. Okay, and Andrew paid a total of 7,000 in alimony payments and 3,000 child support to his ex-wife. Brandon,
I think because he paid, all of it's deductible.
what, the 7 and the 3?
Yeah,
Lows.
I know the child support is definitely deductible. I'm not sure about the alimony though.
Vice versa. This is for sure deductible. Child support has no effect. You can deduct it and the person receiving is not taxed.
But the person receiving the alimony adds it to their taxes, right?
So his ex-wife is gonna add the 7, but do nothing with the 3.
Okay.
Alimony 7. And the child support 0. Any questions here?
Yeah, I have a question.
Yeah, what up?
The deductible just means what he's not being taxed on, right? Is that it?
Deductible
Yeah.
means not only is he not gonna be taxed on it, whatever this total is, he's gonna subtract from his total income, and then he's gonna be taxed on the difference. He's deducting it, he's subtracting it.
Okay, so not only is not adding it, but he's subtracting as well. Okay.
Correct. No effect, he's not adding and not subtracting, it's just nothing. But deductible is actually subtracting, those are good things. We like things that are deductible, because it saves us tax.
But no effect, does that mean that there's no tax on it as well?
Yeah, we're not taxed, but we're not deducting it either. No implication on the tax return.
Okay.
Okay, so.
When I was doing an example, I saw that it said a deduction was like childcare expenses. What's the difference between childcare expenses and child support?
Childcare expenses would be like you and your spouse, whatever, are paying a daycare to take care of your kids. That's childcare expenses. You're paying a daycare, you're paying a babysitter.
Okay.
Support would be you and your spouse are divorced. One of them is paying the other.
Okay. Okay, that's perfect. Thank you.
No problem. Okay, and yeah, that's it. Let's do these stupid ratios. So Aaron Breeze took a summer intern position at Monroe Security Limited after finishing his year study at John Molson School of Business. Drew Rogers, Aaron's mentor, asked Aaron to analyze Bell Canada's Enterprises, BCE, and TELUS Communications Company. Selected condensed financial statements of BCE and TELUS are presented below. FY just means fiscal year. So to give us all the stuff for Bell and for TELUS, we're gonna have to do 2 companies. Okay, there's additional info required. Aaron recalled from his COMM 217 class that equity analysts generally conduct analysis of a company's profitability, liquidity, and solvency. So he decided to evaluate 3 ratios. Return on assets. They love that one, return on assets. One of their favorites. the quick ratio, and the times interest earned. Calculate these three ratios for both BCE and tell us for FY fiscal year 2011. What conclusions would Andrew draw? Okay. So a return on assets. You take net income plus interest expense. 1 minus the tax. All over average total assets. So
Question, yeah. Apparently, like, because I watched the first mock earlier today, and a student said that one of the teachers said that for return on assets, you're able to just do profits over average total assets. Like
Yeah.
net.
Yeah, that's what they said this year. I mean, look, the real formula is like this.
Okay.
I think it was Brad who said it. Could it be? It was you who said it, Brad?
Yeah, I said it, and basically my teacher said they accept both, but it's just easier to use profit in the numerator just because it is.
Whichever. I mean,
I think it depends on the teacher because my teacher says she specifically told her TAs to use both.
yeah, maybe not every teacher says to use that. So I'm just gonna do what I know is for sure right, which is this.
Whose class are you in? Like, what's the teacher's name?
Carmen, I don't know her last name.
All right, I know she is.
So BCE, we're gonna take the net income, which is the profit, which we need the income statement of this. We're gonna add back the interest expense. Add back the interest expense over here. And we have to multiply by 1 minus tax. We don't have a tax rate. So what's the tax rate? How do I figure out the tax rate? That is-
Maybe like the number before taxes divided by the amount being taxed, or the other way.
Yeah, the other way around, exactly. The income tax expense, 554 out of 3146 is gonna give you a rate. And that's 17.64. And you do the same thing over here for Telus. 328 over 1366 gives you their tax rate. And for Telus, the numbers we're gonna use are these ones. Any questions, Mike? No question, Mike? Okay, so using those exact numbers for BCE for Bell. 2592 plus 674, 1 minus the tax. Over average total assets. So over average total assets. So we're taking this plus that over 2. That plus that over 2. And for Telus, that plus that. wanna put this in percentage, this is like saying 8.3. Okay. That's how I got for color. Any questions? Right, next one is the quick ratio. Quick ratio, here we do cash plus short-term investments plus net accounts receivable all over current liability. So let's go look at BCE. Cash. That, and there's no short-term investments over the current liabilities of this. For tell us it's gonna be that, and that. Questions? $779 plus 1896 all over 5953, which is 0.45. Oh, also, before I forget, if you guys have any questions, those of you relying on the recording, or anyone has any questions in prompt 217, just send me a message and I will get back to you. I have to make time to do it. So tell us, we said we're gonna do 25 plus 973 all over 3949, and then 0.25. 0.25. And the last one is times interest earned, what they wanted. Times interest earned. So here you take the profit plus interest expense plus income tax expense all over the interest expense. Oh, let's take a look. So we said the profit, aka the net income, plus the income tax and the interest all divided by interest. Question here, Brandon? Agree?
Yeah, in the ratio like list you gave us, it says time interest earned is profit before interest and taxes over interest expense,
Same thing.
not plus interest and taxes.
Well, if I take this number, I add back this and this, I'm gonna end up with the profit before interest and taxes.
Oh, okay. Yeah, that makes it easier.
Just that it won't always be given to you nicely like this. So that's why I don't want you to rely on that. So always get used to adding them back. Over here for BCE, Bell 2592 plus 674 plus 554 all over 674 is 5.67. And Capellas 1038 plus 510 plus 328 all over 510 is 368. And now what do they want in part B? Oh, sorry, they wanted to know what conclusions would Aaron draw? What conclusions would Aaron draw? So let's go one by one. Who's getting a higher, who's doing better in terms of return on assets? Is it higher is better or lower?
Higher?
Higher is better, good. So BCE is doing better. So I would write something like BCE has a higher return on assets than TELUS. And now what does that mean? BCE is managing its assets more effectively. Than TELUS. Right? Who's doing better in the quick ratio? How does this work? Is higher better, higher worse?
Isn't it like always better? Higher?
Um, it depends. Like not for debt to equity, right? It's gonna make it more debt to equity. So most of the time, higher is better. Um, so who's doing better here?
BCE.
BCE, right? So I would write BCE has a higher quick ratio than TELUS. Now, what does that mean? Higher quick ratio than TELUS. Now, what does that mean? That means BCE has higher or stronger short-term liquidity because it measures liquidity. And times interest earned. Bell could pay their interest expense 5.67 times, and TELUS only 3.68 times. So BCE has a higher times interest earned ratio. So creditors would prefer to lend money to Bell instead of TELUS.
What does that ratio mean?
Basically, it's how many times could they pay off their interest expense. So Bell could pay off their interest expense 5 times, whereas TELUS only 3.
Did you write that instead? Like just say that they could pay off their interest expense more than TELUS?
Well, I was gonna get to that now because BCE can pay off its interest expense 5.67 times. Okay, B. Drew asked Eric to strengthen his profitability analysis by further considering the quality of earnings ratio. Calculate the quality of earnings ratio for both BC and TELUS. Why did he ask Eric to calculate the quality of earnings in addition to return on assets? What conclusions would Aaron draw? So, quality of earnings ratio is the cash flow from operating activities, which is always going to be given to you. You're not going to have to make the cash flow, don't worry. They're going to give you it too. Divided by the net income. So we have this divided by each of the net income. They wanted to know why did he ask us to do it and what conclusions could we draw? Okay. Part B. Quality of earnings. You take cash flows from operating activities. Over net income. So BCE 4724 over 2592. The net income. Let me know if you missed where I got these numbers. I'll show you again. And TELUS, I have 2546 over 1038. So quality of earnings. Measure the portion of earnings. Measures the portion of earnings that was generated in cash. Basically, it indicates that a company's ability to finance indicates a company's ability. Indicates a company's ability to finance its operations from cash flow. Okay. Both BCE and TELUS have quality of earnings bigger than one, which indicates high quality earnings. Any questions? And C. Aaron received a phone call from a client who wanted to buy security with a high price earnings ratio. What does the price earnings ratio measure in general? So letter C, price earnings. Price earnings. Price earnings measures the relationship between the current market price. Per share. And its earnings per share. Price earnings is essentially market price per share divided by EPS. So for Bell, the market price per share, they told us is here. But the EPS, we're gonna have to figure it out. So we have no preferred share. So our average number of shares is 759. Okay. So here we're gonna say 35.46. Over the EPS. So the EPS, we know it's net income minus preferred dividends, which is none, over the average number of common shares. So the net income, we said 2592 minus 0, over, we just said 759. So 3.415. That's 10.38. And you're gonna do the same thing for Thales. So by asking you to do the PE, you automatically have to do the EPS. So Thales, we're gonna say this 320, and they have 1,038. So here we said 43.56 over. We're gonna figure out their EPS. Net income minus preferred dividends all over average number of common shares. 1,038 minus 0 over 320 is 3.24375. And you show the number there. We get 13.43. And which one did he recommend? Since the price earnings of Thales is larger than BCE, Aaron recommended Thales to this much. And that's that. Because the client was asking about PE. Price earnings.
So like, if you were to invest in it, you'd make more money. per share. Is that what it means?
Not necessarily, just that investors generally prefer the ones with higher PEs. Can't say with certainty you make more money, but that it should be the better investment. Okay, so we did all of that. And now let's hit the multiple choice. So which of the following types of inventory is not held by a manufacturing business? Is merchandise inventory. The rest of the stuff I'm going to teach you in COMM 305, but you have it in the notes over here. Number 2, which of the following should be included in the cost of inventory? Shipping and handling, because this is essentially freight in. Which of the following inventory system keeps an ongoing record of purchases and sales of inventory with adjustments that reflect changes as they occur? This is perpetual. Which of the following costs would normally not be included in the cost of equipment? Insurance for equipment after it started being used. That's not included. But the rest is all. Intangible assets include leaseholds, patents, and copyrights. Right, building you can touch. Trade receivables is not intangible at all, and neither is that. These people purchased a tract of land with the intention to transform it to a cocoa plantation. Before the new seedlings to be planted, the site, which is cocoa flooding, must be drained. The cost of the drainage should be going to the cost of land. So the whole idea is, you have to first drain this seedling, drain this flood, and that is basically getting the land ready for use. Yeah, so it doesn't go to the. So this goes for land because you're getting the land ready for its use. Any questions? Jeffers Inc. purchased the warehouse and the land upon which it was located. The total price was $450, and the land was appraised at $180, and the warehouse was appraised at $360. What balances should be shown? So basically, the land is $180,000. The warehouse is $360. Together, this is $540. This is 33.33%. This is 66.66% times the 450. Here we get 150, and here we get 300. With respect to depreciation policies, the principle of consistency means a company should use the same depreciation method year over year over a capital asset. Which of the following would most likely be classified as a current liability? This would be dividends payable. Number 8, a company's quick ratio can never be larger than the current ratio. Why? Because quick is cash plus short-term investments plus your net AR out of your current liabilities. And your current ratio is current assets over current liabilities. Right, so this ratio will always be bigger. Because this has all the current assets, has all these plus more, right? Like prepaid, inventory. So this will always be more. Any questions? Failure to record a liability will probably result in overstated net earnings. Why? Because when you're recording a liability, when liabilities goes up, shareholders' equity goes down, right? We usually put an expense with a liability, both hand in hand. When liabilities go up, most of the time it's because shareholders' equity goes down. A company, a biotech company, reported cost of sales of 345.2 million and trade payables of 121.6 million for 20x8. In 20x7, cost of sales was 300.8 million and trade payables was 103.9 million. What was a company's trade payables turnover ratio for 20x8? So you take the purchases over average trades payable. So 345.2 over 121.6 plus, don't care about that, 103.9 over 2. And we get 3.06. Caroline's grandmother promises to give her $1,000 at the end of each year for the next 5 years. How much is money worth today, assuming she can invest the money at 6%? So here you're gonna take 1,000 and you're gonna hit with the PV factor. This is the PV annuity where N is 5 and I is 6%. And we go. Most of the information regarding a company's long-term debt is actually in the notes to the financial statement, right? That's where you have all.
Sorry, excuse me. I was just wondering where you got the 4.2124 from.
On a PV table, be given to PV table.
Sorry, sorry, people are talking very loud. Could you repeat that again?
On the PV table, the present value table, they're gonna give you a PV
They're
table.
gonna give us the table.
Yeah, you won't have to memorize it, right?
Okay, all right, perfect, thank you.
Okay. Okay. 13. Milford has debt to equity ratio of 0.8. Its total shareholders equity of 2.5 million and current liabilities of 750. How much long-term debt is outstanding? So you basically just gotta work on this way. Debt to equity, we know is total liabilities over shareholders equity. So 0.8 equals X over 2.5. So X is 2 mil. This is total liabilities. So 2 mil total minus 750,000 current is 1,250 long term. Which of the following represents shares that are currently in the hands of the investors? These are the outstanding shares. accounting entries associated with the cash dividend are usually made on which dates? Declaration and payment date. Which of the following is false? Dividend yield ratio is dividend per, yes, that's good. Measures the profit generated by each share of shareholders based on the market price, yes. A low dividend yield is neither bad nor good, that's true. And dividend yield is, no, is the opposite. Is the dividend per share over the market price. A primary advantage of a general partnership compared to a corp does not include limited liability to the owner. Time series, yeah, Brandon.
It's not limited liability when it's a corporation, right? Then the CEO or whatever deals with it.
Well, when it's a corp, you have limited liability.
Mm-hmm.
It does not include limited liability for partnership.
Sorry, say it again.
Yeah, it's a play on the words here. An advantage of a partnership compared to a corp doesn't have limited liability.
Okay.
It doesn't have, it's tricky here. Okay, the partners, it's very easy to form. There is no income tax in the business, and they have complete control. But it doesn't have limited liability. Time series analysis involves examining a company's financial data across time. Right, that's what time series is. It's the same company across time. Which profit measure is best for assessing how well a firm operates within their industry? Would be the operating profit. And when the occurrence of a liability is dependent on the outcome of a future event, example of lawsuit, the liability is referred to as a contingent liability.
I have a question. Do you think the past like 3 mock exams are enough, or do you think like there's gonna be information that you haven't covered in the next 2?
Let me see the next two.
I have this one, the last one, the one before that.
Yeah, I think one of them I did tax credits as a long answer. I mean, look, if you feel good with the material, I think you're fine. But if you want to see more practice, these look different. Let me see. Let me see this one. They do have some different questions. I mean, there is going to be some similarities, but they are different. If you're looking for tax credits, though, that'll be on mock 5 if you want to see tax credits.
Okay, but then did you already like have a question on tax credits?
Not in a mock, no.
Okay.
Not in a mock. And yeah, other questions here, Braden?
From the mocks that we've done so far, would you say they're easier or like more difficult, or like the same as the exam?
I'm trying to represent it as much as I can, the exam. I'm definitely putting my hard stuff out here is that 217 got completely revamped. It's been since last semester, as you know. So yeah, I mean, I'm going based off that. It's still in process of really fully understanding it. So I'm gonna speak to a lot of you guys, how many questions came on the exam and all that stuff. And yeah, but in terms of difficulty, I think mine is harder than the exam, that's for sure.
Okay.
Especially the tax stuff, that's for sure. Because I'm really trying to put everything, so like in case they ask you just a little bit, you guys have had plenty of exposure, you know what I mean?
Yeah, because the tax stuff I find is the hardest part because it's like you
Yeah.
just have to memorize everything.
I mean, look, what I'm hoping is on the exam, you just get a little thing of tax, you know, and all stuff we've already seen. That would be like a blessing.
Yeah, that and the tax with the cars.
Yeah, if they even test you on that, yeah.
Apparently they're not testing on the car tax.
Not sure. It was in the notes. I did it in one of the mocks just to be safe. But
I heard that too, but in a review from one of the teachers, they had like a cart in it, so I wasn't sure.
I'm not taking any chances. I mean, sure to cover everything.
Wait, did you have a long like I know you did tax credits in like in the final review that I watched it. I don't remember though. I don't know if you remember. Did you do a tax credit question like long answer?
Yeah. Well, Joe taxpayer made X amount of money. What's his taxes payable?
Okay, so you did one in the review.
Yes.
Okay, so that's probably good enough.
Perfect.
Also, I have a question not related to this class, but for Math 208, I noticed 5 mocks. I got 2 of them, like on the 19th, but because I have to study for other exams too. So, do you think like is every exam different, or there's just like more practice material?
They all have their own curveballs.
All of them? Okay.
All of them have their own curveballs. You'll see off 1 and 2. You'll see the differences.
Okay.
All right, so that's it for me. If you guys have any questions, those of you relying on the recording, just send me a message on Instagram at Mike Fans the tutor, and I will answer you. Just note that I'm working 9 to 10 or 10 to 10 every day, so I might only get back to you guys late at night, and I'm kind of seeing the priority of the exams. So whichever exams are first, I'm kind of answering those. And you guys, I think, are on Saturday. So don't worry, anyone who's messaged me, I got you. And feel free to just send me a question mark again if I didn't get back to you in a day or whatever, just so you pop up back to the top of my list. Okay. So best of luck to all. If I don't see you guys in another mock, and yeah, have yourselves a good one. Guys.
Thank you.
Thank you.
Thank you.
Thank you.
You.